Most people think buying car insurance is simple. You go online, you pick a number, you click confirm, and you're covered. Done. But here's what they don't tell you. Millions of people are either paying way too much for coverage they will never use, or they're dangerously underprotected and one bad day away from losing everything they've saved. And almost nobody teaches you the difference. By the end of this video, you're going to know exactly what car insurance actually is, what each part covers, what's worth paying for, and what's just padding somebody else's pocket. Let's get into it. Welcome back to Financial Fundamentals, where we break down money concepts so they actually make sense. Today, sit back, listen up, and learn about car insurance. The real version. Not the watered-down version the insurance website gives you when it's trying to sell you something. So first, why does this even matter? Because for most young adults, car insurance is one of the biggest bills you'll pay every single month. We're talking right up there after rent. And unlike rent, most people have no idea what they're actually getting for that money. They just pay it because they have to. That's exactly the kind of blind spot that costs you hundreds of dollars a year, sometimes more. You're already ahead of most people just by being here and asking the question. Let's start at the beginning. What is car insurance really? Think of it like a financial safety net. You pay a small amount every month, called your premium. That's just the regular payment you make to keep your coverage active, and in exchange, the insurance company agrees to cover certain costs if something goes wrong. A crash, a theft, a hailstorm, whatever the policy says it covers. The key word there is certain costs. Not all costs, not every scenario, certain costs. That matters. A lot. Now let's break down what car insurance is actually made of. Because it's not one thing, it's more like building blocks, and you get to choose which ones you want. Or sometimes you don't get to choose because the law or your lender chooses for you. The first and most important block is called liability coverage. Liability coverage is the part that almost every state in the US legally requires you to have. And here's the key thing to understand. Liability does not pay to fix your car. It pays for the other person's car and medical bills if you cause a crash. Think about it this way. You're driving, you get distracted for 2 seconds, you rear-end somebody. Their bumper is destroyed, they've got a sore neck. Liability coverage is what steps in and pays for their repairs and their medical care, so you don't have to write a personal check for $10,000 or $20,000 out of nowhere. Now, here's where a lot of people make a mistake. Every state sets a minimum amount of liability coverage you're legally required to carry, but those minimums are often dangerously low. Like, they might cover a fender bender. But a serious accident with real injuries, a serious accident with a newer car, you could blow right past those limits, and then you're personally on the hook for the rest. So liability is not optional. But buying more than the legal minimum is something worth thinking about seriously. Okay, the second block is actually two pieces that usually come together. They're called collision coverage and comprehensive coverage. Let me break those down. Collision coverage is exactly what it sounds like. It pays to fix or replace your own car after a crash. Whether you hit another car, or you hit a pole, or you roll into a ditch, collision covers your car. Comprehensive coverage handles everything else. Think theft, fire, a hailstorm that dents every panel, or hitting a deer on a country road. If it's not a crash, but it still damages or destroys your car, comprehensive is what steps in. Here's what you need to know. Both of these are usually optional. Unless you're financing your car, meaning you have a car loan, or you're leasing it. In that case, the lender will require you to have both. Because until you pay off the loan, the bank technically owns that car, and they want it protected. Now let's talk about something called your deductible. This one trips people up all the time. Your deductible is the amount you pay out of your own pocket before the insurance company pays the rest. So let's say you have a $500 deductible and you get into a fender bender that causes $1,500 in damage. You pay the first $500. The insurance company covers the remaining $1,000. A higher deductible, say $1,000 instead of $500, means your monthly premium goes down. You pay less every month. But if something happens, you're on the hook for more upfront. Here's the honest truth about that trade-off. Only choose a high deductible if you actually have that amount sitting in savings, and you could hand it over without it hurting you. If you don't have $1,000 saved up, a $1,000 deductible is a trap. Alright, let's pause for a second. So far, we've covered liability coverage, which is legally required and protects others, collision and comprehensive, which protect your own car, and deductibles, which are what you pay before insurance kicks in. Does that make sense? Good. Let's keep going. Now let's talk about price, because you've probably heard that car insurance for young drivers is expensive. And it's true. Here's why. Insurance is essentially a bet. The insurance company is betting on whether you're going to have an accident. And statistically, drivers under 25 crash more often than older drivers. So the company charges younger drivers more to cover that risk. It's not personal, it's math. But it's not just your age. Your zip code matters. Driving in a dense city where accidents happen constantly costs more than driving in a rural town. Your driving record matters. One speeding ticket can raise your rate. Your credit score matters in most states. And the car you drive matters enormously. Let's make this really concrete with an example because this is where it clicks. Imagine you're 20 years old and you're buying a used 2018 Toyota Corolla worth about $12,000. A sample quote might look something like this. Liability only, around $120 a month. Full coverage, meaning liability plus collision plus comprehensive with a $500 deductible, around $210 a month. Now compare that to insuring a Tesla Model 3. Same driver, same driving record, same age, but a Tesla has specialized parts, specialized repair shops, and repair costs that are significantly higher. That same full coverage policy for the same 20-year-old could run somewhere between $300 and $450 a month. Same person, different car, hundreds of dollars a month difference. And here's the lesson inside that example. Check your insurance quote before you buy a car. Not after, before, because the car you choose dramatically affects what you'll pay every single month. This is one of those things nobody tells you until you've already made the expensive choice. By the way, those numbers are illustrative examples to show you how the math works. They are not actual quotes. Your real numbers will depend on your specific situation. Okay, so now let's talk about the add-ons, the stuff insurance companies offer on top of the basics. Some of it is genuinely useful. Some of it is just padding, genuinely worth considering. Uninsured and underinsured motorist coverage. Here's what that means in plain English. About 1 in 8 drivers on American roads has no insurance at all. If one of those drivers hits you, their insurance pays nothing because they have none. Uninsured motorist coverage is your backup. It steps in and covers you when the other driver can't. That one's worth having. If you don't have health insurance, medical payments coverage is also worth a look. It helps cover your own medical bills after an accident regardless of who was at fault. Now the stuff that's often a waste. New car replacement coverage on a car that's already 5 or 6 years old. That's not doing much for you. Rental reimbursement, which pays for a rental car while yours is being fixed, sounds nice. But if you have another way to get around, that's probably $80 a year for something you'll never use. The point isn't that these are always bad. The point is to ask yourself honestly, will I actually use this? If the answer is probably not, skip it. Now I want to clear up a few things that almost everyone gets wrong. First, full coverage does not mean you're covered for everything. Full coverage is not even an official insurance term. It's just shorthand that usually means liability plus collision plus comprehensive. It still has limits. It still has exclusions. You can still have gaps. Always read what you're actually buying. Second, if someone borrows your car and crashes it, their insurance pays. This one surprises people. In most cases, insurance follows the car, not the driver. That means if your friend borrows your car and causes an accident, it goes on your policy and your rates take the hit. So be thoughtful about who you hand your keys to. Third, red cars cost more to insure. Completely false. The color of your car has zero effect on your premium. What matters is the make, the model, the year, the engine, and how much it costs to repair. All right, before we wrap up, let's just take a beat. What's the one thing from today that surprised you most? Was it that liability doesn't cover your own car? Was it how much the type of car affects your premium? Was it the thing about your friend borrowing your car? Think about that for a second. Because that thing that surprised you, that's the gap that used to cost people money before they knew better. And now you know. Let's bring it all together. Here's the most important thing to take away from today. Car insurance isn't one size fits all. It's made of pieces, and each piece covers something different. Liability protects others. Collision and comprehensive protect your car. Your deductible is your out-of-pocket before insurance steps in. And the car you choose to drive has a massive effect on what you'll pay every month. The smartest move you can make right now, whether you're shopping for your first car or you've been paying the same rate for 2 years, is to get multiple quotes, at least 3, for the exact same coverage. Because prices can vary by hundreds of dollars between companies for the same policy, 30 minutes of comparing quotes is one of the highest return uses of your time in all of personal finance. If this helped you make sense of something that always felt confusing, I'd love for you to share this with someone who could use it. A friend who's buying their first car, a younger sibling, somebody in your life who's just figuring this stuff out. That's what Financial Fundamentals is here for. To make the concepts that actually affect your life feel simple and clear. And if there's a money topic you've always been confused about, drop it in the comments. We go through every comment, and your question might become the next video. This video is for educational purposes only and is not financial advice. Markets and investments carry risk, including the possible loss of principal. Always do your own research and consult a licensed financial professional before making investment, tax, or money decisions.